We now proceed with measurement. So for measurement, we have initial and your subsequent cost or subsequent measurement. Okay? So an owned investment property, take note, this is owned, meaning this is not leased. So there are basically two types of investment property, those that you own and those that you are leasing out under finance lease. So in the case of owned investment property, it will be measured initially at cost. Okay? So again, cost talk going back to the provisions of cost. Okay, those are the amounts that you're going to recognize, which will be initial cost and subsequent cost that is relating to enhancement or improvement. Transaction cost shall be included in the initial measurement. What are transaction costs? These are costs that are directly related to bringing the asset to its intended location or condition. Okay? So the cost of purchased investment property, okay, so when you talk about purchase investment property, comprises the purchase price and any directly attributable expenditure. Directly attributable expenditure could involve professional fees or legal fees, transfer taxes, and other transaction costs such as import duties or whatever. But of course, it is impossible for you to have import duties because land or building cannot be imported. Okay? So that is the reason why you do not see import duties in this case. Because it is impossible to purchase an investment property and import it from one place going to another. Okay? Because land and building cannot be transferred from one place to another. So that's the reason behind. Okay. So that's basically for purchase. Okay. And it says here to specify the provision of the standard, the cost of an investment property is not increased by the following. So these are the usual items that are shown in the theories. So startup costs in general is not capitalizable or is not added to the cost. However, it says here, unless the startup costs are necessary to bring the property to the condition necessary for it to be capable of operating in the manner intended by management. Okay. So what do we mean by this? Okay. Let's say for example, we have land. Okay. The land, if the land purchased is not in good condition, okay? Meaning, if let's say for example, the land we purchased um, is not yet, or it is not clear as to where the boundaries of the land are. So what you did was you placed, let's say for example, you placed um, let's say you place some boundaries or wooden or concrete barriers, okay, on the boundaries just to secure the boundary of the property. So that could be considered as a startup cost. So it says here, startup costs are not capitalizable. However, if you can justify that this particular startup cost is necessary to bring the asset, okay, or for the asset to be capable of operating in the manner intended later on, then you can capitalize it. So um, it is a matter of justifying that the startup cost is necessary. Okay, so basically that's what it means. What are other example of startup costs? It could be pertaining to leveling the land, or it could be pertaining to cleaning the building. Okay, those things. Okay, so generally those are not capitalizable, but if you can justify, okay, if you can justify that it is needed, then it is going to be capitalizable later on. Okay, however, for operating losses and abnormal amounts of wasted materials, labor, and other resources, they are never capitalizable. So among the three items here, it is only the startup cost that is optional as to capitalization depending on your justification. Okay? For operating losses and abnormal amounts of wasted materials, labor and other resources, they are always expensed and they will never be capitalized. Okay, next. So similar to your inventories and later on also with property, plant, and equipment, in the case of payments of investment property that is deferred, then you need to get the present value or the cash price equivalent, and any difference or any excess from the cash price or the present value over the total payment will be charged as interest expense. So basically, you get the total payment that you're going to make, and then you deduct the present value or cash price equivalent. Any difference will now be charged to interest later on. So this is going to be, so for every time that you're going to make payment, there will be amortization of interest. Okay? So that's basically how it works. Next, in the case of acquisition through exchange, okay? So meaning is either you will acquire an investment property and you're going to exchange another asset, you're going to exchange a liability or a financial liability, or it is going to be an exchange of equity, then you need to follow the guidelines provided by the standard. So in the case of exchange of asset, you need to ask yourself, exchange of other asset. Of course, it does not pertain to cash anymore. Okay, in exchange of other assets, you need to determine whether the exchange has commercial substance or it has no commercial substance. Okay? As discussed in your lower years, if there is commercial substance, then you need to consider the fair values. Okay? The fair values first. And if there are no fair values, then we're going to use the book value. Okay? So the rule there is GRG. Fair value given up. Okay? Plus or minus, or plus cash paid minus cash received. If there is no fair value given up, you go to fair value received. Okay? And then if there is no fair value received, then you go to book value given up plus cash paid minus cash received. That is for exchanges with commercial substance. If the exchange has no commercial substance, then you simply go to book value. Okay? We will discuss in detail when we are already in property, plant, and equipment what it means by commercial substance. But generally, it talks about, or if there is commercial substance if the characteristic of the asset you received and the characteristic of the asset you gave up are different. Okay? So that's basically what it means. Okay? So in the case of liability, then you're going to follow the IRI rule. You first get the fair value of the liability, okay? And then you get the fair value of the asset. And then finally, you get the book value or carrying value of the liability. So that's the value that you're going to attribute as the cost of your investment property. In the case of equity, you're going to use RII. Is either you're going to get the fair value of the investment property or the fair value of the equity instrument that you issued. Of course, you're going to carry the amount that is more clearly determinable or more measured reliably. Like if let's say for example, there is the fair value of the investment property and there is also the fair value of the equity. Basing it on IFRS 13, you determine which valuation is more reliable by determining if the fair value given is level 1, level 2, or level 3. So example, the fair value of the property is a level 2 fair value, while the fair value of the equity is a level 1 fair value, or that is the market based. So what are you going to follow? Of course, you will follow the fair value of the equity. You will carry that as the cost of the investment property because that is the more clearly determinable value. Okay? However, if there are no fair values, then you are going to use the par value of the equity as the value of the investment property that you're going to receive. So more on that when we are already in property, plant, and equipment. Because basically, this will be repeated again when we are there. Okay? Because PPE and investment property are generally the same type of asset. Okay, the only difference is the purpose why you have it. Okay. So with that, we now go to subsequent measurement. So before we go to subsequent measurement, again to reiterate, for initial measurement, we always focus on cost. Because costs, okay, all the costs that are capitalizable, that will be the amount that will be or that will be recognized as the initial amount of the investment property. Okay? So under subsequent measurement, the standard stated that an entity must choose an accounting policy and shall apply that policy to all of its investment property. Okay? And the standard provided us with two options. Okay? But before that, before we go to the next slide, just to emphasize, it says here, the policy that was chosen should be applied to all of its investment property. So meaning, later on, you will see that there are basically two items. We have the fair value model and the cost model. Okay? Or the fair value method and the cost method. Okay? So, whatever option was chosen or whatever accounting policy was chosen, it must be applied to all investment property. Okay? So, the next slide is what makes the new standard or the updated IAS 40 different from the previous version. Okay? Because in this case, there is going to be a choice of fair value or cost model, but there are subclassifications. So let us go to the first one, letter A. An entity may choose either the fair value model or cost model for all investment property backing liabilities that pay a return linked directly to the fair value of or returns from specified assets including that investment property. Okay? So, if the investment property satisfies this requirement, okay? Or if the investment property is backing liabilities that pay returns linked directly to the fair value, okay? Then it can choose fair value or cost model. Okay? So the letter A is talking specifically to investment property that satisfies this requirement or this criteria. You can choose either fair value or cost model. However, letter B, you can choose either the fair value model or cost model for all other investment property regardless of the choice made in letter A. Okay? So what do we mean by that? It simply means that although the standard stated that the policy should be applied to all of its investment property, there is also a requirement by the standard to classify your investment property as to letter A and letter B. Okay? So this means that it is possible that an entity will have two classes of investment property. Class A, or the first class, which is based on the requirement of letter A, and Class B, which is based on the requirement of letter B, or those that are other than those in letter A. So, what does that mean? It simply means that all items of investment property that belong to Group A or Classification A, you must apply either the fair value or cost model to all of them. Okay? So it is not possible that under Class A, some are using fair value, some are using cost model. Okay? You need to use only one method or one model to all the investment property that are classified under letter A. And then, all investment property classified under letter B, you must choose only one model, either fair value again or cost model, to all of those. Okay? And it says there, regardless of choice made in A. So example, if investment properties in Group A, you chose fair value model. For investment property in Group B, You can choose fair value, you can still choose cost model. So the choice of accounting policy in Group A does not preclude you from choosing the other option in Group B. Okay? So example, Group A can be fair value, Group B can be fair value also. Group A can be fair value, Group B can be cost. Group A can be cost, Group B can be fair value, or cost and cost. So that's basically how it works. Okay? But okay, there is a caveat here because it says here in choosing an accounting policy, okay, or in changing an accounting policy, it should be made only if the result, okay, in the financial statement will provide a more reliable and more relevant information. And the standard stated, particularly IAS 8, it says there that it is highly unlikely that a change from the fair value model to the cost model will result in a more reliable presentation. So what does this provision do, or how can this provision affect the accounting choice that we have here? Okay. So this particular provision in IAS 8 will affect our choice here. Okay? So what does that mean? It means that if we chose the fair value model, okay, or whenever we choose the fair value model either for Group A or Group B, and then later on you're going to apply IAS 8 to change the accounting policy. Okay, change the accounting policy from fair value to cost model. Okay? The standard in IAS 8 stated that it is difficult for you to do so because it is rare that the change from fair value to cost model will result in a more reliable information or more relevant information. Because generally, fair value is more reliable and more relevant than the cost model. So, what does this mean? It means that if you already chose fair value model, it is more likely than not that you will stick with fair value model. But if you chose cost model and you use the provision of IAS 8, it is more likely than not that a shift from cost model to fair value model will result to a more reliable and more relevant information. So in other words, fair value model to cost model is difficult to achieve. Okay? It is difficult to achieve because you need to really justify it. Cost model to fair value model, very easy because the standards will favor that particular change because it will result to a more reliable and more relevant information. There. Okay, let's proceed. So going back, we're already done with this one. IAS 40 further requires all entities to measure the fair value of investment property for the purpose of either measurement if the entity uses the fair value model or disclosure if it uses cost model. Okay? So this is where the provision becomes tricky. Okay. So the standard said you can use fair value or cost model. Okay? We will not or the standard will not hinder you from choosing whatever, no. However, if you chose the fair value model, you're all good. If you chose the cost model, you still need to disclose, okay, the fair value. Okay? Di ba? If you are already using fair value model, then you are good already when it comes to measurement. You don't need to make further disclosures. Okay? Unless stated specifically by the disclosure requirements. However, if you are using cost model, you are further required to disclose the fair value of those investment property that are under cost model. Okay. Now, what is the justification behind this? Okay? It's basically like this. Unlike property, plant, and equipment, it is it is generally impossible for an investor to invest in an investment property that has no fair value. Of course, if you are an investor, you will always look into its future value. You're going to look into the return that you're going to get from it. Okay? So, the return that you're going to get from it can be directly obtained from the valuation or indirectly obtained from the amount of rental that you are receiving, okay, from that property. So in that case, the standard generally wants you to use fair value for investment property. Okay? You are still given the freedom to choose cost model, but from there, using cost model, you are still required to disclose the fair value eventually. Okay? So that's basically where it becomes tricky. Okay? Next, an entity is encouraged but not required to measure the fair value of investment property on the basis of a valuation by an independent valuer who holds a recognized and relevant professional qualification and has recent experience in the location and category of the investment property being valued. Okay. So, since we are talking about fair value, and we're talking about fair value under the provisions of IFRS 13, the standard is highly encouraging the entities who have investment property to get fair value that is based on independent valuer. Okay? And the independent valuer should be qualified, experienced, okay? And highly knowledgeable in technical matters. Okay? And of course, and actually this is one of the disclosure requirements later on. Again, this is not required but it is highly encouraged. Okay. Now, we focus specifically on the fair value model. Okay. So if the entity chooses the fair value model, these are the requirements. So after initial recognition, sorry, after initial recognition and the entity chooses the fair value model, it shall apply, okay, the fair value model to all of its investment property, okay, except in the cases where there is inability to measure fair value reliably. So this is the exception to the rule. Okay? We stated a while ago that the policy must be applied to all investment property. But in this case, there is an exception, okay? Because obviously, you cannot use the fair value model to properties that have no fair value. Okay? That's why it is provided here. We will discuss that in detail afterwards. And if you are going to use fair value model, any change in fair value will be recognized in profit or loss. Okay? That's very simple. So if let's say for example, initially the cost was 1 million and then at the reporting period, the fair value was assessed to be 1,100,000. The 100,000 difference is already going to be recognized in profit or loss. Okay? So that's how it works. Okay? Now, this is talking about change in fair value. It is not talking about change in fair value less cost to sell. Okay? Do not consider cost to sell in this case. Okay? It is considered in some remeasurements, okay? But in this case, it is only talking about fair value. So you simply compare the carrying amount and the fair value. Do not consider any cost to sell. Okay. So, proceed. When measuring the fair value of investment property in accordance with IFRS 13, okay, the entity shall ensure that the fair value reflects, among other things, rental income from current leases and other assumptions that market participants would use when pricing investment property under current market conditions. This is what I am talking about a while ago. Because fair value measurement can be done directly and indirectly. Diba? When you talk about direct fair value, this is the assessment itself. Okay? And when I talk about indirect fair value, if there is no quoted price, you can get the present value of all future expected leases. Okay, get the present value at the required discount rate, and then you will get the fair value at this point. Then that's how you can determine. So the standard provides that you use whatever information necessary or all relevant information in measuring the fair value. Okay, so that's what the standard provides. Okay, and when a lessee uses the fair value model, in this case, because in measuring the investment property that is held as a right of use asset, then it shall measure the right of use asset and not the underlying property at fair value. Okay. So what do we mean by this? Okay. Um, in a way, this is difficult to explain, particularly if you do not have a background in IFRS 16. But let us simply discuss it this way. If I am the lessee of a right of use asset, the amount that I am going to recognize as the balance or as the carrying amount of my investment property or as the fair value of my investment property should not only be based on the underlying property. Okay? If we try to go to your IFRS 16, the capitalizable cost of your of the right of use asset does not only pertain to the lease liability. It also contains it also contains initial direct cost, it also contains penalties, it also contains um, uh, decommissioning cost and other direct cost. Okay? So, the standard simply says that if you are a lessee and you have an investment property because you are under a finance lease, what you need to do is remeasure or measure the fair value based on the entire component of the right of use asset and not only of the underlying asset. Okay? So in other words, do not only compute for the fair value of the leased property, but the fair value of all the components, okay, that covers the lease. Okay? So that's how it works. Okay? It sounds complicated, but basically, what this is trying to say is do not only focus on the leased property, but instead focus on all the amounts or all the considerations that covers your lease contract or that covers the lease. Okay, so that's basically what it means. Okay, so also another component or another concern in determining the carrying amount of investment property under the fair value model, an entity does not double count assets or liabilities that are recognized as separate assets or liabilities. Okay. So what do we mean by double counting? It simply means that we should not make the mistake of combining assets or liabilities that are not related to each other and um, separating assets that are supposed to be together. So example, in a building, you have elevators and air conditioning or thermostat or whatever. Okay? Although the elevator or the escalator or the air conditioning can be considered as a separate PPE, you should not separate it from the total amount of the investment property because the air conditioner, the air conditioning, the escalator, and the elevator are integral parts of the investment property. Okay? So therefore, you are not supposed to separate the air conditioning, the escalator, and the elevator as PPE. Okay? Because it is an integral part of your investment property. Okay? Another example, if you have an investment property and it has furnishings, okay, so it has tables, it has paintings, it has let's say a complete equipment in the kitchen or whatever, you are not supposed to separate the investment property and these furnishings, because the furnishings are integral parts of the value of the investment property. So meaning, the reason why people want to rent that particular investment property is because of all these amenities or these particular furnishings. Okay? So do not separate them from each other. Okay? Let's have examples of items that you are supposed to separate. Okay? So if let's say for example, um, there is the investment property and there are accrued liabilities, or there are accrued expenses or prepaid expenses that are related to the investment property. So the investment property and the accruals and the prepayments should not be added together with the investment property, because the accruals and the prepayments are not integral parts of the investment property. Even if you remove these accruals, let's say for example, prepaid utilities, okay, or there are supplies, or there are, let's say for example, there are accrued utilities tools that are not yet paid in relation to the investment property, you are not supposed to include them in valuing the investment property, because they are not integral to the valuation. So the decision guide is like this: in determining the fair value, those that are integral, or those that are important or essential in holding the value of the investment property, should not be recognized separately as other assets. But items that are not integral to the valuation of the investment property should be separated from the valuation. Okay? So that's basically what it means. Okay. So that's what we mean by double counting. Okay? Double counting assets or liabilities. Okay? So from there, let's proceed. Okay? If an entity has previously measured an investment property at fair value, it shall continue to measure the property at fair value until disposal, or until the property becomes owner occupied, okay, either through or becomes part of inventory through a transfer, even if comparable market transactions become less frequent or market prices become less readily available. Okay? So this means that if you are using fair value model, consistently use the fair value model and apply the requirements of IFRS 13, even if the frequency of the fair value, okay, changes, or even if the level of the fair value changes. Okay? So example, previously the fair value is available every month. This time, the fair value is only available every 6 months. Still, there is fair value, so continue using it. Second, previously, the fair value that you have is based on a level 1 or a quoted price fair value. And then from there, the fair value is now become has now become level 2 or an observable data only. So still use the fair value model because you can still apply the provisions of IFRS 13. Okay, so that's basically what it means. There. So now this is the issue here. Okay? Under fair value model. You are using fair value model, but then what if the fair value is not available anymore? Okay? Unlike in the previous slide where the frequency and the level changes, this time there really is no more fair value. Okay? So if there is no more fair value, then what are you going to do? Okay, so it says here, in exceptional cases, there is clear evidence when an entity first acquires an investment property that the fair value of the investment property is not reliably measurable on a continuing basis. So, although this is a rebuttable presumption, it is possible that initially there is fair value, but now you can no longer continually measure the fair value because there is no more fair value. So what are you going to do? It says here, if an entity determines that the fair value of an investment property under construction is not reliably measurable but expects the fair value of the property to be reliably measurable when construction is complete. You are constructing an investment property, okay? And the fair value is not yet available, but expects the fair value of the property to be reliably measurable when construction is complete. It shall measure the investment property under construction at cost until either its fair value becomes reliably measurable or construction is completed, whichever is earlier. Okay? So, first case, you have an investment property. Currently, there is no fair value because it is not yet completed. But once it is completed, there will be a fair value. So what is the decision guide there? Initially, you measure it at cost. Okay? And then once it is completed, you now remeasure it at fair value. Okay? So that's the first case. Second case. Okay? If an entity determines that the fair value of an investment property, okay, other than the one that is constructed, is not reliably measurable on a continuing basis. Okay? The entity shall measure the investment property using the cost model in IAS 16 or property, plant, and equipment for owned investment property or in accordance with IFRS 16 for investment property held by a lessee as a right-of-use asset. Okay? However, the residual value of the investment property shall be assumed to be zero. Okay? The entity shall continue to apply IAS 16 or IFRS 16 until disposal of the investment property. Okay. So in other words, you are using fair value model. However, the fair value of one of your investment property has no more fair value or it is not already available. Then what are you going to do? If the property is owned, use use IAS 16 and use the cost model. Okay? However, do not put any residual value. So basically, if the cost is 1 million and the useful life is estimated to be 10 years, so 1 million divided by 10. So you simply depreciate it for 100,000 every year. Okay? If the investment property is a right-of-use asset, then use IFRS 16, wherein you're going to depreciate it based on either the useful life or you're going to depreciate using the lease term, whichever is relevant in the case, because it depends on the provisions of or the contractual provisions of the lease. Okay, so that's how it works. Okay, now we go to the cost model. The cost model is very simple. That's why we discussed this last. Under the cost model, what you simply need to do is you get the cost and depreciate it or impair it if there is impairment. Okay? So, after initial recognition, an entity shall choose or that chooses the cost model shall measure investment property, okay, letter A, in accordance with IFRS 5, okay, if it is going to be sold. In accordance with IFRS 16, okay, if it is not going to be held for sale, and in accordance with IAS 16 for the cost model in all other cases. Okay. So if you are using or if you opted to choose the cost model for investment property, there are 3 standards that you're going to refer. IFRS 5 if you are going to classify it as held for sale. IFRS 16 if the property is a leased property, and IAS 16 if it is going to be or if it does not belong to IFRS 5 or IFRS 16. Okay, so that's very simple. As a general rule, under the cost model is going to be cost minus accumulated depreciation and minus accumulated impairment losses. Sorry. So that's how it works. Next, we go to transfers and disposals. Ito Tuloy na natin, dire-diretsoin na lang natin para hindi na tayo mag-break. Anyway, patapos naman na to. So we go to transfers and disposals. Okay. So when you talk about transfers, it pertains to transfers into investment property or out of investment property. And just like what we said a while ago, transfers out of investment property could either be transfers from investment property to inventory or transfers from investment property to PPE. Okay? So what does the standard say? An entity shall transfer a property to or from investment property when and only when there is a change in use. Okay? So if you are already going to change how you're going to use it. So meaning, if you're going to eventually if you're going to remodel or to modify the property and then sell it, okay, then it is going to be an inventory. If you're going to change the use from investment property to owner occupied, then it will become PPE. Okay. So a change in use occurs when the property meets or ceases to meet the definition of investment property and there is evidence of the change in use. In isolation, a change in management's intention for the use of a property does not provide evidence of a change in use. Okay. So, what triggers the transfer? The trigger is the change in use and not the intention for the use. Okay? So, even if there is already a change in the intention of management, if there is no actual change in use, then there should be no transfer yet. Okay? So, example, I have an investment property and management has decided to have it sold or have the investment property sold. Okay? It will not automatically trigger a transfer unless there is an actual action. Example, if management has already made changes in the property or the tenants have already been evicted. Okay? So, those particular actions will result in the transfer. Okay? The mere intention or the mere change in intention does not result automatically with transfer. Okay. So, examples of evidence of a change in use include, okay? Letter A, commencement of owner occupation or of development with a view to owner occupation for a transfer from investment property to owner occupied property. Okay? So this is what I was telling a while ago. The tenants are now being evicted. They are asked to get out of the property and the property is now being remodeled. It is being it is being reconstructed or there has been modifications, okay, in relation for it to become owner occupied. Okay, letter B, commencement of development with a view to sale or a transfer from investment property to inventories. Take note, commencement of development, meaning in order for the investment property to become inventories, there should be a development first. Meaning you're supposed to modify it. Okay? This is actually what differentiates inventories from non-current asset held for sale. Because non-current asset held for sale are assets that are going to be sold at its current condition. Okay? So, if let's say for example, the investment property will be sold as is, then the transfer will be from investment property going to IFRS 5 or non-current asset held for sale. But if prior to selling, you're going to fix and you're going to modify the property first, then it is going to be investment property going to inventories. Okay, so that's the main difference between inventories and non-current asset held for sale. Okay. Other examples, letter C, end of owner occupation for a transfer from owner-occupied property to investment property. And inception of an operating lease to another party for a transfer from inventories to investment property. So those are examples of transfers. Okay. For a transfer from investment property carried at fair value to owner-occupied property or inventories, the property's deemed cost for subsequent accounting in accordance with IAS 16, IFRS 16, or IAS 2 shall be its fair value at the date of change in use. Okay? Again, this is the reason why it is better to use fair value. Because in case of transfers, there will be no valuation needed anymore because the current fair value or the recorded fair value will just be transferred. So that's basically going to be debit to, in the case of PPE, you simply debit PPE and you credit investment property for the same amount. No need for revaluation. In the case of IFRS 16, the same. It's going to be a debit to do you I think you don't need to change the classification anymore if that's going to be operating lease. But if it is finance lease, then that's going to be a debit to receivable and a credit to investment property. In the case of inventory, that's going to be a debit to inventory and a credit to investment property, same amount. Okay. Sorry for that. Okay. If an owner-occupied property becomes an investment property that will be carried at fair value, okay, an entity shall apply IAS 16 for owned property and IFRS 16 for leased property. Okay? The entity shall treat any difference at the date between the carrying amount of the property in accordance with IAS 16 or IFRS 16 and its fair value in the same way as the revaluation in accordance with IAS 16. So basically, what does that mean? It simply means that if you are going to transfer PPE going to investment property, so that's from PPE going to investment property, what you simply need to do is if it is let's say for example held at cost, okay, and you're going to transfer it as investment property and you're going to measure it at fair value, then what you need to do is to apply the provisions of either IFRS 16, which we will discuss later on, and in the case of IAS 16, the concept is simply to use the revaluation model. Okay, meaning you are now going to recognize any relevant revaluation surplus. Okay, so that's basically how it works. Okay, how to do revaluation, we're going to discuss that in detail when we are already in PPE, because you will only have revaluation model if it is already a property, plant, and equipment. Okay, now what if we have transfers from inventories to investment property? Okay, inventory to investment property, that will be carried at fair value. What you're going to do is to remeasure the inventory at fair value, and any difference in fair value will be recognized in profit or loss. So that's going to be a debit to investment property at fair value, a credit to inventory at the carrying amount, and then any difference, it could be credit for gain and debit for loss. Recognize it in profit or loss. There. Okay. When an entity completes the construction or development of a self-constructed investment property that will be carried at fair value, any difference between the fair value of the property at that date and its previous carrying amount shall be recognized in profit or loss. Okay. So what does that mean? Okay, this is in relation to the previous example wherein upon or at the time of the construction of the investment property, there is no fair value available yet. So, of course, you are going to carry it at cost first. Okay? Now, upon the completion and there is already fair value, let's assume the total accumulated cost is 5 million and the current fair value is 5,500,000. Then, you're going to debit the investment property for an additional 500,000 and credit gain on fair value change of 500,000. There will also be a situation wherein the total cost will exceed the fair value. So this is talking about impairment on initial recognition. So example, the total cost accumulated is 5 million, but the fair value assessment was only 4,800,000. So what you're going to do is to debit impairment loss of 200,000 and credit investment property for 200,000 in order for the fair value to be reflected at 4.8 million. Okay. Finally, we go to disposals. It says there, an investment property shall be derecognized or eliminated from the statement of financial position on disposal or when the investment property is permanently withdrawn from use and no future economic benefits are expected from its disposal. Okay? So, transfers and disposals are different. Because transfers is simply a change in classification, disposal is the recognition or the removal of the item of investment property from our financial statement. Okay? So in this case, whenever there is a gain or loss, similar, okay, you're going to recognize the gain or loss in your profit or loss. Okay? So gains or losses arising from the retirement or disposal of investment property shall be determined as the difference between the net disposal proceeds and the carrying amount of the asset. Okay? In the case of disposals and there are compensations from third parties, okay? The compensation from third parties for investment property that was impaired, lost, or given up shall be recognized in profit or loss when the compensation becomes receivable. In other words, in the case of disposal and there are losses, do not set off or do not offset the amount of compensation to the loss. Okay? You recognize the loss separately from the gain from compensation. So that's very easy. That's actually very self-explanatory because you do not really offset items of receivable and payables or items of income and gains. Oh, sorry. Income and losses. You do not offset them unless offsetting is allowed. Okay. Finally, we go to disclosures. These are the last requirements. Hopefully, there will be no questions in the word examination relating to the line items in the disclosures because once again, that's very unfair. You're not supposed to be tested for your memory, but rather of your knowledge in the accounting concepts. Okay. So for both fair value and cost model, you need to make disclosures as to what accounting policy you chose. So whether you chose fair value or cost model. When classification is difficult, similar to what we discussed initially, you need to disclose also the criteria that you established to determine whether a property is PPE or investment property. And then the extent to which the fair value of investment property is based on a valuation by an independent valuer. This is already discussed a while ago. If you use the services of an independent valuer, you need to disclose that. And you also need to disclose the the qualifications, the skills, and the experience of the independent valuer so that the users can be satisfied that the independent valuer is really qualified to do the valuation. And if there has been no such valuation, you also need to disclose it. Okay? So, if you did or if an independent valuer did the valuation, you disclose all the facts relating to how the valuer did it and the qualifications or the background of the valuer. And if there is no valuation, you also need to make that disclosure. Okay? Also, you need to recognize the amounts recognized in profit or loss for the rental income, the operating expenses, whether there is no income or none. Okay? Because regardless of whether rental income is earned or not, there will always be operating expenses because there will always be repairs and maintenance for the investment property. Okay? And also, you need to provide the cumulative change in fair value. Okay? In profit or loss relating to the sale of your investments. Okay? Or the pool of investment property that you have. Okay? In addition, for both fair value and cost model, you need to recognize or to disclose the existence and the amounts of restrictions on the realizability of investment property or the remittance of income and proceeds of disposal. So this is in the case wherein there is a legal or there is a governmental or whatever type of restriction imposed on the investment property. And also, the contractual obligation to purchase, construct, or develop investment property or for repairs, maintenance, or enhancement. So you need to disclose also if there are plans for these particular items. Okay? Now, let's focus on the fair value model. Under the fair value model, since everything is already at fair value, okay, what you simply need to do is to make disclosures for certain additions, okay, for certain acquisitions, for assets classified as held for sale, and for the net gains or loss from fair value adjustments. Okay, so it's already very easy because everything is already at fair value and you already disclosed how the valuation was done. So you only need to make additional disclosures as to how the amounts in the investment property change. And usually this is in relation to acquisitions, in relation to disposals, in relation to changes in fair value. So those are the amounts that you're going to disclose. Okay. Also, you're going to make also the necessary disclosures for net exchange differences arising from translation, particularly if you have investment properties in different countries that have different functional currency as compared to the presentation currency. Okay. We also have transfers to and from inventories and owner-occupied property, and finally other changes, whatever items affected your investment property. And then for fair value still, you also need to disclose why is it that there are some properties that have no fair value. Okay, so this is a disclosure specific for those investment properties that you claim to have no fair value. Okay, because the rationale here is like this: why will an investor purchase an investment property that does not have a fair value? So since the entity is claiming that the property has no fair value, then the necessary disclosure should be provided, such as the description of the property, the explanation of why there is no fair value. It could be possible that the property is under or is involved, or the property is in a location that is currently in distress because of peace and security. Like example, the property was in a war zone, like that. Okay, so that's possible. And if possible, the range of estimates within which fair value is highly likely to lie. And finally, for investment properties where no fair value is available still, okay, upon disposal of the property, you still need to disclose the related facts relating to the disposal of that property. Okay, there. And then for cost model, because you are using cost model, these are very simple disclosures. You simply need to disclose the depreciation method, the useful life or the depreciation rate, the carrying amount, and the accumulated depreciation as well as impairment losses at the beginning and end of the period, meaning there should be a reconciliation of the balances. And of course, just like what we said a while ago, since you are using cost model, you are still required to disclose the fair value of the investment property. So that's basically the end of the presentation or the topic relating to investment property.